Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn Associates with your agriculture update, and here we are now on Wednesday, the 6th of February, 2018. All right, tomorrow morning we're going to come in 11 o'clock in the morning. We're going to get a grain report. It will affect the cotton market. It's going to affect all the grains, as you could see, and it's still a very, very wild situation we're getting. I was on Fox TV today. The stock market at that point was up about 200 points on the day. So not down 65, up 200 points about. And I was asked by Linn claimant, she said, Ira, you've been bullish the market. She said, what do you think? And I said, I think it's time you take money off the table because the market had front-loaded so much and this volatility is scary. When you get really volatile markets like you're getting here, they're often not at the bottom that they get volatile. It's when you've made a peak in a market that it gets super volatile. In the grains, the quiet wheat market, the quiet corn market. Remember how sideways they were going? I'll show you that in a moment here. They're the ones that's how bottoms often are made. Often. You go sideways. This choppiness we're getting, I don't trust it in the stock market. When we look at a weekly area chart of closes, for tomorrow you have to make up your mind, what is the USDA report going to say? What's our ending stocks going to look like? And we're all going to be looking to see what South American crop prospects look like. But here you are. The market is over the 18-week moving average of closes. That is friendly. When we go to a daily area chart of closes, the market was up, pulled back a little bit. So you're down 3 cents today in the bean market, very close to that 18-day moving average of closes, the line in the sand, as I like to refer to it. If you take a look at what's going on, this is still an area of pretty stiff resistance up here. You broke down through that, getting a rally back up, okay, but where do we go? On the swing line, you have no story. You're not trending. What you have is a higher high and a lower low. The definition of an uptrend is normally higher highs, that's plural, higher lows. Downtrend, lower highs, lower low. When you get one of a higher high and a lower low, it's just no trend in the market. I am not surprised but what happened. Here was yesterday. The market came back, got over the 18-day average. What had been support, the 100-day moving average of closes, often becomes resistance on the way back up. So the market got up and over it, and look where it pulled down, almost right back to the 18-day average of closes at 982.25. Not unexpected action. What is happening is your Bollinger Bands are hooking. And what that means is that the market is now bringing down the resistance point, bringing up a support level, and they will continue to hook as the market stays in this big swath that it's created over the past week or so. We wait and see. Obviously, the catalyst tomorrow should be after we see that USDA report. In terms of momentum, it still has a downside bias to it. I think you could agree with that, but it has flattened out in terms of the momentum indicator called slow stochastics. If the market gets under today's lows and it's under the 18-day average of closes, you do understand that you'd have lower highs. You already have the lower low. It would change the market. Don't take out today's low, and you could still have this pattern in place. Even if you took out today's high and didn't take out the low, it would still be that pattern. So the one pattern that can happen quickly is taking that out. Now, there's another part you always worry about reports. Let's assume it takes out today's low, doesn't get through 967, and then intraday starts turning back up, closes higher on the day. You would end up with then potentially, you could have higher lows, especially if that high were taken out after making the low, and higher highs. A dangerous day for a report. That's my point. When we come to the meal market, you've got a lower low, a higher high, neutral. Momentum is flattened out, not doing much of anything. Battleground. Past 4 sessions, 18-day average of closes. This market's looking for direction. Maybe we'll get it with that report. You tell me where you think the market saw resistance in the soybean oil. Look at this chart pretty hard. Here's yesterday's action. Market had a big reversal up. Resistance could be the upper Bollinger Band. Today, market's high, 33.29. The Bollinger top exactly 33.29, and you fell right back through the 18-day average of closes. Are you trending? No, you haven't been. You're just almost every day hitting this 18-day average as this market is looking for its next direction too. In the corn market, this is what I was saying. Here was quiet action, not trending. And I think I said that if you go back to those tapes, you were getting no follow-through up or down. Then it finally poked through. And after the fact, admittedly, the market just kept moving itself up, fell back the other day to the 100-day average, tried to get to the 18 and made a new high on the move. Along the way, you've had, if you look at this area right here, what we call an embedded reading. Both numbers are over 80, over 80, over 80. Until they lose that, you're still looking for bias, strong bias to the upside. The market pulls back, drops back, as you'll see. Did you lose the embedded reading? Did either of these numbers get over 80? The answer is no. The market's holding on, and now the question is, can it get up to the upper Bollinger Band? That's basically what I'm looking to see. If you lose the red line, then I look for prices to come back here. But this market is bullish. Wheat had a similar formation, and it too is following through. But unlike corn, not an embedded reading. You have an overbought condition that is not trending. I'd be a little cautious going into that report in the grains. In the sugar market, market has tried everything to fall back here into support, hasn't been able to do it. Will it be able to get to the upper Bollinger Band at 14.14? Today's high was 14.04. That number will slip down tomorrow, so we'll see if that offers the resistance. In the coffee, my eye goes to the almost sideways action that is now being displayed by the dashed black lines, which are the Bollinger Bands. The green line is the 100-day average of closes. Momentum is up, but you're not in a trend. You have a pattern of a higher high, a lower low, momentum up, bias up. If the market continues to rally, I think the pros will look for resistance at 125.10. In the cocoa market, you peaked out now against the upper Bollinger Band. Today you had what we call an outside day down. It took out Tuesday's high, low, closed lower. Admittedly, what had been, if you look at it, the 100-day average of resistance, you can see it there, how's the market played back and forth. You got over it. You fell back to that number. That's my theory, that what often was a resistance point becomes a support point when you revisit it. And today you're starting to slice through it. You closed on it. If it goes down, look for support at the 18-day average of closes. Momentum has turned down in this market. It was overbought. Now it's starting to shift. The bias is up. The trend is down. It's a confusing chart. Not everything's together. Cotton market in tomorrow's data as well. If the market early on gets down to those lower numbers, I would not be surprised to see pros take money off the table. In the cattle market, you're still in an uptrend. Higher lows, higher highs. You have divergence. You've got momentum, which often leads prices pointing to the downside. The market is pulled back to the 18-day average of closes, but because it closed over it and because the swing line is still up, you are in an uptrend with divergence in momentum. In the feeder cattle, same type of plan. You've got divergence. What was a resistance point on the pullback could become a support point. 18-day average, more support. Market still looking from the swing line bullish, from the bias up because it's over the 18-day average, but it's fighting with its momentum. And in the hog market, take a look. Right through the lower Bollinger Band. So you've just gone from 73.97 in one swoop down to 69.22. These hogs are a hard market to trade. I have become convinced, and I've mentioned it, that I think the high-frequency boys are in these markets. The charts are very, very difficult to try to catch. want to remind you about my research, because tomorrow I'm going to be writing about the grain market. Tonight I'm going to be filling people in on the Senate deal that's happening for a budget, but it's got to go back to the House of Representatives. Nancy Pelosi doesn't want to pass it. Well, you can get all our information, mine especially, by giving us a call or going to my website. If you go to the website, you'll see a carousel of free offers. All you need to do is click it. You'll be working with it. You'll see all the offers we have. Choose what you'd want. We'll get it to you. You can click up here if you watch me on YouTube, and underneath us, you can watch us. I'm Ira Epstein. You have a good day, and I'll see you tomorrow.